it's 1,246%, right? So if you take the level here, which is around 50 times, have you got a calculator there, Clive? So 50 times 1,246%. Well, that's $623. So, there are people, I think Bank of America is talking about $309 silver. So there you go. And here's the monthly chart, Clive. It still looks pretty bullish, doesn't it? I know we had
Yeah,
that move to 121, but tomorrow I think we could make it this week we could make a new high. Who knows?
I've been stacking ever since I was 18 years old, Mario, and often I bought at prices which seemed like an all-time high at the time, and I just bought two more coins this week or last week actually, and as far as near as makes no difference, the all-time high.
The mathematical case for a silver breakout suggests the current bull market is far from its peak, with technical models pointing to a move towards $623 per ounce. This calculation is based on a 1,246% increase applied to historical baselines, aligning with aggressive institutional forecasts. MarioInnecco, a former London-based bond broker and creator of the Innecco 64 financial channel, is joined by Clive Thompson, a retired Swiss private banker with over 40 years of experience in high-net-worth wealth management. They argue that despite the brief surge to $121, the monthly charts maintain a strongly bullish structure that points toward a systemic shift into real assets. While Bank of America has officially signaled targets near $300, the percentage-based model suggests the true ceiling could be double that figure as the dollar continues to lose its purchasing power. Veteran stackers emphasize that buying near all-time highs has historically proven to be a sound strategy, as the overarching trend of currency debasement consistently pushes silver to new higher floors, making the current volatility a mere stepping stone to the next record. Now, we present the clips from MarioInnecco and Clive Thompson's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I did this chart here because I think this Iran war, whatever you want to call it, operation whatever, is a big enough event to compare to 9/11. And this is what happened to gold after 9/11. It bottomed just below 300, and then it went on a bull market for the next 9 years or so. And we're already in the bull market now. So I think we could accelerate. This could be a trigger. And Clive, some people are saying that this war, whatever you want to call it, could be an excuse for the powers that be to revalue gold and basically say, it wasn't our fault. It's because of we had to stop Iran, because they're going to bomb, build a nuclear weapon and so on and so forth.
I think the United States has no choice but to revalue gold at some point in the near future. Whether they revalue it to the current market value or a higher level, I don't know. But when they do the revaluation, it will create them a few $trillion of effective cash, which they can use to reduce the debt or pay their bills. So it's kicking the can down the road, and they can obviously repeat that trick a few years later if they want to. But if they do revalue gold, it will put a floor under the price of gold at whatever level it is. And I think realistically speaking, if they do revalue it, they probably should choose a level which is nearly 3 times the price today, which is about 15,000. That's if I was the United States, that's where I'd put the number right now.
Well, I'm going to bring up that chart I brought up earlier of gold, and I've adjusted here. This was the first time it was around here that I heard about a cup and handle, and it was Jim Sinclair who had his website. I followed it. He was talking about it that once we broke through, I think at the time it was around 420, 430, that it would move up quite sharply. So it took a little while to develop the handle, but once it broke out, I mean, look at it. It went to 1,000. So, and then it corrected, but that's why I said it can go even more. But of course, this happened in '05, '06. And you just have to be patient because it took 6 years and we went to 1900. And then there is this cup and handle here, which seems to be working really well. This one here.
Hmm.
Yeah. So, and I think that, yeah, and there's the war right now. And this line here, I remember in 2024 looking at it because I knew it was going to come in around 2,700. And
Mm.
and once it broke out of it, it went up to like 2,800 or 850. And then after the US elections, it came back below it. But yeah, I thought that was really important, 2,700. And I don't get these things right all the time, but this time it's worked, you know?
You
So
know, the environment for a higher precious metal price in gold, silver, and platinum as well is 100% there. Nothing's gone away. Nothing's changed.
no.
War or no war, we are in a situation where the confidence in currencies is reducing gradually, and there is a real possibility that at some point in the next decade we could go into a currency crisis, which of course will send gold effectively to a very, very high price.
Yeah, let's look at let's measure here because the question was about that, wasn't it? So let's go from the bottom here to here. It's 1,246%, right? So if you take the level here, which is around 50, have you got a calculator there, Clive?
I can bring one up on the computer.
No, let me just do it on my phone here. And then let's see what the objective is. So 50 times 1,246%. Well, that's $623. There are people, I think Bank of America is talking about $309 silver. So there you go. And here's the monthly chart, Clive. It still looks pretty bullish, doesn't it? I know we had
Yeah,
that move to 121, but tomorrow I think we could make it this week we could make a new high. Who knows?
you know, I've been stacking ever since I was 18 years old, Mario, and often I bought at prices which seemed like an all-time high at the time, and I just bought two more coins this week or last week actually, and as far as near as makes no difference to the all-time high. But I don't have a particular worry. I'm pretty sure that in 3 or 4 years' time, I'm going to be looking at the prices I paid today and saying, wasn't I a smart cookie?
The current geopolitical climate, particularly the escalating tensions in the Middle East, is being viewed as a significant black swan event comparable to 9/11. Historically, such triggers have ignited decade-long bull markets. Post 9/11, gold bottomed near $300 before beginning a 9-year ascent. Today, technical analysis highlights a massive cup and handle formation that has successfully broken out, suggesting that the recent surge to $2,800 was only the beginning. As confidence in fiat currencies gradually erodes, there is a growing consensus that the United States may eventually use geopolitical instability as a pretext to revalue gold. By setting a floor at $15,000, the government could effectively create trillions in cash to service the national debt, essentially kicking the can down the road while fundamentally resetting the global monetary base. On a log scale, the trajectory for precious metals remains exceptionally bullish, with silver following a similar path toward a calculated objective of $623. This projection is based on a historical 1,246% move seen in previous cycles, which would dwarf current bank forecasts of $309. Despite the risk of short-term volatility, the long-term trend remains intact because the underlying environment for gold, silver, and platinum, defined by currency debasement and war, has not changed. For veteran investors, buying near all-time highs is not a deterrent but a strategic move. In a decade characterized by a currency crisis, today's record prices will likely be viewed as bargains. The market is accelerating toward a new reality where real assets are the only reliable store of value in an increasingly unstable world. Let's get back to the interview.
If you look at that chart of gold, uh, and you've done your homework and you know that gold is money and the dollar is the opposite of gold. It's a currency that used to be, a promissory note for gold. Then the dollar is already crashing because the higher gold goes, the lower, less value the dollar has. And why is that? Well, because for thousands of years, gold has been, you know, the key store of wealth and measure of value, right? But it's not just the dollar crashing. All other currencies are going down versus gold. I think the dollar will remain still an important currency as a method of payment, but more and more central banks, Clive, are buying gold for their reserves, and very wealthy individuals and funds, right?
The dollar's going down against gold, and that's the main thing we should be measuring it against. But, even if you measure it against other currencies, it's down 10% last year against the other currencies. If you look at the
Yeah,
DXY, and
yeah.
it's down another, 2 to 3% this year, and we're
Mm.
only 2 months into the year. So that's on par for another 10 or 12% down.
I'd rather exchange my fiat for gold and silver and always keep my silver. But where would I think right now, probably not the best time. I think silver is going to start outperforming again, or maybe not. But probably right now is not a bad time to convert some silver to gold, but keep your silver, I would say. In terms of percentage, yeah, I think it should be the other way around. You should have more gold because silver will do really well, I think, going forward. So if you have 10% in silver, 90% in gold, in a few years' time, that could be more like 40/60.
We're currently at a silver gold ratio around 57 times. 57 ounces of silver makes 1 ounce of gold. I know a few months ago we were at 100 to 1, but that was really an exception. 57 to 1 where we are now is not out of line with the long-term ratio of gold to silver, but there's been plenty of times where we've been down way, way lower than that at 30 or 40 times an ounce of silver. So if I was even thinking of changing silver to gold, I'm definitely not going to do that. But if I was doing it, I wouldn't be doing it at today's price. I would be waiting for a better price, i.e., for the ratio to be maybe below 30 times, i.e.,
Yeah,
30 ounces of silver buy you an ounce of gold. But I think we'll probably get, there's a good chance we'll, at some point in the next decade, we might well get to 10 to 1.
I agree with you. And back in 2011, it got down to 31 to 1 around that level. I think this time around, we're going to break through that level. And yeah, we could go back to 10 to 1. Historically, of course, in the last few hundred years, prior to like the late 1800s, it was always around 15 or 16 to 1. And I think during Roman times, Clive, it was 12 to 1.
Yeah, and if we go, we quite like to get back to those levels, but I think it will overshoot, and that's why I say 10 to 1 is a possibility.
Yeah, yeah. There's some people who think it will go 1 to 1. People like Bix Weir. He's very bullish gold. Have you heard of Bix Weir?
No, but you can't exclude anything. There is a
Yeah,
demand for silver for industrial use. Every ounce of silver ever produced has effectively been consumed. I
yeah,
mean, obviously some above the ground, but it's not like gold where it's all above ground. Silver, which is mined, is 100% consumed. So
yeah.
if the demand continues to rise, there's no telling where the price could go relative to gold. It could become more important than gold because there's always going to be plenty of gold in a certain sense. But silver is in very short supply now for those who need it.
The relentless ascent of gold prices is the clearest signal that the US dollar is undergoing a structural devaluation. While the dollar remains a dominant medium for global payments, its value is eroding significantly when measured against hard money. Having dropped 10% in 2025 and an additional 3% in the first 2 months of 2026, the currency is on track for another double-digit decline this year. Central banks and ultra-wealthy individuals are responding to this silent crash by aggressively shifting reserves into gold. However, the most explosive opportunity may lie in the silver market, where the current gold-to-silver ratio of 57:1 remains historically stretched. As the ratio moves toward a more traditional 15:1 or even overshoots to 10:1, silver is positioned to dramatically outperform gold, reflecting its status as a finite, 100% consumed industrial necessity. The fundamental difference between the two metals is that while gold is stockpiled, silver is systematically destroyed through industrial use. Every ounce of silver mined is effectively absorbed by the technology and energy sectors, leaving a structural deficit that gold does not face. This silver shortage is becoming a critical driver of price discovery, as the metal is increasingly seen as more strategic than gold for modern infrastructure. For investors, the strategy is shifting from mere speculation to essential wealth preservation, maintaining a heavy core in gold for stability, while utilizing silver's higher velocity for massive appreciation. As paper currencies continue to lose their utility as stores of wealth, the return to historical bimetallic ratios is not just a possibility, it is an economic inevitability in a world of limited physical supply. Share your thoughts on the gold-to-silver ratio and your own stacking strategy in the comment section below. If you find this analysis of the dollar's decline and the silver supply crunch insightful, please support us by liking this video and subscribing to our channel for more deep dives into the precious metals reset. Don't forget to hit the notification bell so you never miss a market update. Thanks for watching.